Happy holidays, everyone. Just over a week ago, the Federal Reserve Board increased the Fed funds rate by 3/4 of a point. And then a few days later, inflation data came out showing that inflation was beginning to decline just a little bit, and the Fed's plan may be beginning to work. As a result of that, last week, mortgage rates actually fell 5/8 of a percentage point. Um, and so rates about a week ago were sitting around 7 1/8. Today they're sitting at market around 6.5%. But I can tell you without a doubt, this has been one of the most volatile markets of my 20-year career. And it can be frustrating day to day sometimes to understand which way the tide is turning based on the news headlines of the day and what's happening with the broader global economy. But what I've also found is that it presents great opportunity. And so a lot of our clients, particularly our most savvy investors, are finding great opportunities right now. And also some of those would-be home buyers that have wanted to purchase a home for the last 2 or 3 years, but have not been able to because of too much competition or because prices have been bid way up too much, are now finally getting their chance to be able to capitalize on opportunities. At the same time, I would tell you that sellers that we're working with are still selling on average for 6% more than their house was worth a year ago. And so homes do still move. There were 2,000 homes that sold in the Austin market last month, but it's more than ever, it's critical that you have a game plan for how to make that occur these days with a team that's experienced and has seen some of these cycles in the past. But mostly I wanted to talk about the October data because we're seeing signs now of a leveling off point for the Austin market, and it points to kind of some of our predictions for the market next year in Austin. And so I want to share some of those just real briefly. So these are the October numbers. And back in the beginning of the year, back here in January, this is sales price. We had no inventory at the beginning of the year, 9 days worth of inventory, and prices ran up very sharply, 12.5% through the spring market. And then in about April, the Fed began hiking interest rates to cool off the housing market and the economy in general. And it's had great effect. And so we started to see shortly thereafter the prices peaked, and then they started coming down. And they've been coming down every month for about the last 6 months, to where today we're exactly where we were at the beginning of the year. Now, this past month was the first month where that pricing level was held. It did not decline. And so it's going to be interesting to look at next month and see if that occurs as well, or if prices may decline a little bit more. Statistically or historically, prices would be a couple of percentage points lower in the winter months in Austin. So the real telltale sign is not going to come until spring. But now with the midterm elections behind us, we think that maybe some people will come off the fence, and it's going to loosen up some activity on both sides, both buyers and sellers. But we'll just have to wait and see looking forward. Um, Looking at number of sales per month, so we continue to see that buyer demand shrink. Part of that is seasonal with the winter months in Austin, but also a lot of it is being driven by the persistent rate hikes that we saw on interest rates in July, August, and September. Now, the past couple of days, we've seen rates drop from 7 1/8 down to 6.5. So who knows what we see going forward? Kind of a leading indicator of that as we look at mortgage applications. And but we do expect to continue to see solds per month be at a lower volume in the winter months. And if you look at like the October pending, so we expect to see November closings would decline just a little bit, and then traditionally December and January would be lower. 1,700 to 2,000 units a month would be normal winter month sales volume in Austin. And of course, that was pre-pandemic, and we've added probably 100,000 people or more in the last 2 years. So we'll keep an eye on that, on those sales numbers, but that kind of indicates what buyer demand looks like. And what's been interesting is as we talk to the mortgage lenders that we work with in the different spaces, it's not that they're having a hard time getting buyers qualified. They've got lots of buyers that they can qualify at 7.5, even 8% if they had to. They've got strong income, they've got strong assets, they've got good savings in the bank, good balance sheets. The problem is with confidence. So most buyers out there are simply sitting on the sidelines, waiting to see what happens. A lot of them are waiting to see if prices come down. And I'm just going to cut to the chase. We don't think that prices are going to decline all that much, if at all, in the Austin market. And I'm going to explain why. So you look here at new properties by month. So these are new listings coming on the market each individual month. And you saw this speaks back to the spring market when the Fed began hiking interest rates. There was sort of this rush by sellers to capitalize on the peak of the market and hurry up and get their house on. And so you saw this huge run up. And then after rates went up, subsequently, it's sharply decreased. And looking ahead in the next year, traditionally your high months you can see would be in the spring and summer season. We actually think that looking ahead into next year, that you're going to see a lot less new inventory come on the market than past years. And the reason is that 4 out of 5 existing mortgage holders in Austin right now have a rate that's 4% or less. So if you're a seller and your mortgage is at 2.5, 3.5, 4%, it's highly likely that you're going to elect to stay in your existing house, not move. Maybe you'll renovate, maybe you'll add on to the house. But we think that there are going to be fewer would-be sellers in the years ahead because so many of those sellers, 80% of them, have a rate at 4% or less. To that end, this is the total number of homes available in the Austin market. So what's been interesting has been to see that it's held pretty steady now for 4 months in a row. So even though buyer demand has been going down with higher rates, particularly in the last couple of months when they were over 7%, the new sellers coming to market is also declining in tandem with that decrease in buyer demand. And so as a result of that, we've seen the total inventory sort of level off, or the available homes for sale level off last couple months. And the telltale sign will be of when the market turns is when this starts to come back down again. But expireds is something that we haven't spoken to a lot in our previous market reports, but I thought this was interesting. Expireds are homes that get put out for sale and they never sell, and so the seller just takes them off the market. And I think this speaks to the number of unmotivated, the lack of motivated sellers in the Austin market. So I read a headline last week, some data reports saying that Austin has the most housing equity of any real estate market in the country. And so you've got all these sellers out there that have a ton of equity in their house. They've got a 3% mortgage rate, and they say, you know what? If I can't get my price, I'm just going to stay put. I'm not going to move. So I think you'll continue to see that trend occur looking ahead. Days on market has tracked up, so it's taking about 53 days on average for a home to sell in the Austin market. Historic average in Austin would be 65 to 70 days. So we're not back to the historic norm yet, but I think we'll probably be there by the end of the year. But you know, the days of, you know, sell my house in 24 hours, that was not normal. That's gone by the wayside by now. And but I expect that we're probably going to level out somewhere near the historic average of around 2 months, you know, 2 to 2.5 months, somewhere in there. Inventory, again, is starting to level out. So this is a measure of that buyer demand versus seller activity. And we're starting to see those equalize a little bit. So be interesting to see. I would expect that you're probably going to see inventory tick up a little bit more over the holidays, because those are traditionally very slow months. Not a lot of people like to move over Christmas and in January, but we'll keep an eye on this through spring and see what numbers do. But you know, looking from a historic perspective, we're still only at 4.7 months of inventory, which is traditionally a seller's market. And so if you look at this is the same chart, but going 30 years back, all the way back to 1990 in the Austin market. This is where we are today. This is the pandemic kind of craziness we've had the last 2 years, but we're right back in line with where we've been for about the previous decade. And, you know, I can tell you these years in here, 2012 through about the beginning of 2020 into 2019, Austin very consistently produced annual appreciation of 6 to 8% a year. I'm not saying that that's what's going to happen going forward, but I think that the likelihood that we have these huge price declines that some buyers are waiting on is unrealistic. And if you look at sales by month, our this is the moving 12-month average. This is tracking back down in line with the trend line here. And so I think we're about to a leveling off point in terms of demand starting to equalize a little bit. And another thing I hear from people, a question I get a lot is, well, what about builders? Aren't builders overbuilding? Are they overextended? There are a few that are a little bit far out in front of their skis right now. They've got too much inventory off the ground, and we've had buyers take advantage of that, getting some really nice, healthy discounts to clear that inventory off year end to first quarter. Particularly some of the bigger publicly traded guys are trying to get stuff off their books by the end of their fiscal year for stock reporting and things like that. There's some really good opportunities right now. But you can see that back in as early as like the beginning of summer, back in June, they were already pulling back sharply on new permits being issued. And the moving average is quickly coming back down in line with where it was back in 2019 prior to the pandemic. And so I think that there's going to be a window of opportunity for some discount purchases over the next 6 months, maybe into spring. But I think that very quickly builders have adjusted to decrease the number of new starts that they're putting out to market to match buyer demand looking forward in this new interest rate environment. So looking ahead in the next year, I think it's going to be interesting to see what interest rates do. But I think the bigger factor is not that. I think it's consumer confidence. And bear in mind that the number one factor in any local housing economy is job growth. And we've been seeing a lot of nasty news headlines about Facebook laid off, or Meta laid off 11,000 workers last week. Twitter just laid off half their workforce with Elon Musk coming in, and everyone's saying, oh gosh, that's going to be terrible for Austin. Well, I would actually say that that may have the inverse effect of what the media is going to make you believe. And the reason being is that if you look at the last couple of cycles, beginning of 2020, when COVID and quarantine first occurred and the whole economy shut down, and then you look back at the housing crisis in 2008, 2009, we actually had a huge in-migration of people that moved here because the cost of living was relatively less than where they were coming from. And also, even though the job economy at times, like in 2008, job market was difficult here, it was challenging, it was still better than wherever they were moving from. There was more opportunity here than the market that they left. And so just to kind of dig into that a little bit further, I went and did some research online, and I found a gentleman that he tallies data on the tech sector and industry layoffs, keeps a very detailed record, air tables on all this stuff. And what was interesting to me that I found is that year to date, if you go year to date in 2022 through the first week of November, if you look at the Bay Area market, so that's San Jose, San Francisco, Silicon Valley, there have been 37,000 people laid off in the tech sector. You look at Austin, 700 people. Think about that. 37,000 people in the Bay Area, 700 people in Austin. And then you think about, well, if 10% of those workers that have been laid off in San Francisco elect to say, this is kind of a jumping off point for me. I'm going to look at an environment where I've got a better quality of life, lower taxes, lower cost of living, another market where there's good job opportunities. A lot of those people are going to come to Austin. And you look at the broader economy here, you've got a much more diversified job market here than you had 20 years ago, back in 2001, 2002, during the tech bust. Now you've got biosciences with the Dell Medical Center coming in. You've got manufacturing, of course, and then the big 800-pound gorilla that doesn't get that much press because it's a government entity is the Army Futures Command. And if any of you don't know what that is the cybersecurity and defense technology arm of the Army that was created a few years ago, and they elected to headquarter in downtown Austin. And they have a $6.5 billion a year budget, and they are mandated to spend $3.5 billion a year to advance defense technology and cybersecurity for the military and the federal government. And I can tell you that there is a reason that Amazon leased 5 towers in the domain, and it wasn't because they wanted to deliver toilet paper to you in the same day. They leased 5 towers in the domain because Amazon Web Services, which is their cloud hosting and drives the bulk of their profit for the company, wants to be positioned in a location where they can capitalize on opportunities to capture as many of those cyber command contracts as possible for cybersecurity and data hosting and so forth. And that's just one company out of many that are locating here for that. I was in a room last week with a panel discussion on cybersecurity and defense, and it was fascinating the incubator and the amount of capital and bright minds that are coming into Austin in that space. So anyway, case in point, I think that the economy here locally is too robust and too well diversified that real estate is going to suffer long term. I think there may be a few bumps in the road over the next 3 to 6 months, but I do think that when that buyer demand returns, whether it's when consumer confidence returns or maybe when interest rates tick down another quarter or half point, maybe they get closer to 6%. I think that when that buyer demand does return, that this inventory surplus that we've seen form over the last 6 months could vanish just as fast, if not faster, and we'll be right back to a bottleneck of housing in Austin. So leaving it on that note, if we can help you strategize, we'd love to have a discussion with you. Please feel free to reach out. And on a side note, we'd just like to say that we're thankful for each and every one of you and the trust that you place in us. And I hope that all of you have a very happy and safe Thanksgiving. Thanks so much.